Every market crash creates two types of people, the ones who panic and lose money and the ones who quietly get rich. And this isn't opinion, it's math. $1,000 invested in the S&P 500 on the worst day of the COVID crash turned into roughly $2,800 by 2026, a 181% gain, while most Americans were panic selling everything they owned. 13 crashes since 1950, 13 recoveries, 0 exceptions. By the end of this video, you'll see the exposed data behind every major market crash and the 3 specific moves that separate people who build wealth from people who lose it. Let's get into it. April 2025. The U.S. government announces sweeping tariffs on nearly every trading partner. In 2 trading days, the S&P 500 loses over $5 trillion in value. Headlines call it the worst drop since the pandemic. Social media is flooded with people selling their entire portfolios. 8 weeks later, the market recovered everything. By late June 2025, the S&P 500 hit a new all-time high. The COVID crash of March 2020 wiped 34% off the market in weeks. Businesses shut down. Unemployment surged. The entire global economy froze. Recovery took 6 months. By December 2020, the S&P 500 was at a new record. The 2008 financial crisis was the big one. The market fell 57% over 17 months. Banks collapsed. People lost their homes. It felt like the financial system was ending. But here's the part most people miss. Even if you had invested at the absolute worst time, the peak in October 2007, right before the crash, and simply held on, your money still would have grown at roughly 9.5% per year over the long run. That's almost exactly the market's historical average. The worst possible timing still produced average returns. Go back further. Black Monday, 1987. The market dropped over 20% in a single day. Full recovery took 2 years. The dot-com bust of 2000 wiped out $5 trillion in value. It recovered. The oil crisis of the 1970s dragged the market down 48%. It recovered. Every single time, the recovery was bigger and lasted longer than the crash itself. So if the market always comes back, why do most people still lose money? This is where things go wrong for most investors. A J.P. Morgan study found that the average individual investor earned just 2.9% per year over a period when the stock market returned around 10% annually. The market returned 10. The average investor got less than 3. The reason isn't bad stocks. It's bad behavior. When the market drops, fear takes over. People sell to stop the bleeding. Then they sit on the sidelines waiting for things to feel safe. By the time the market feels safe again, the recovery has already happened, and they buy back in at higher prices. They sell at the bottom. They buy at the top, over and over again. This is called the behavior gap. And it is the #1 wealth destroyer for everyday investors in America. And here's what makes it even worse. The market's biggest up days almost always happen right next to its biggest down days. If you sell during a crash and miss just a handful of the best recovery days, your long-term returns collapse. The people who win aren't smarter. They aren't luckier. They simply don't sell. Now, 3 moves you can make right now so the next crash builds your wealth instead of destroying it. Step 1. Set up automatic contributions and never touch them. If you have a 401k through your employer, your contributions are already automatic. Do not reduce them during a crash. If you're investing through a brokerage account or IRA, set up automatic monthly transfers today. Here's exactly why this works. When prices drop, your regular monthly contribution buys more shares at lower prices. When the market recovers, those extra shares multiply your returns. This is called dollar cost averaging. and it turns every crash from a threat into an advantage. Think of it this way. If your favorite store put everything at 30% off, you wouldn't stop shopping. You'd buy more. Crashes are the same thing. Stocks are on sale. The specific action: log into your brokerage or retirement account today, confirm automatic monthly contributions are active, and commit to not pausing them regardless of what the market does. Step 2. Build a crash fund before the crash arrives. This is separate from your emergency fund. Your emergency fund covers rent, groceries, and bills if you lose income. A crash fund is different. It's cash you set aside specifically to invest when the market drops significantly. Here's the setup. Open a high-yield savings account. Set aside a fixed amount each month, even $50 or $100. Don't invest it. Let it build. When the market drops 20% or more from its recent high, deploy that cash into a broad index fund like an S&P 500 fund. You don't need to time the exact bottom. Nobody can. You just need to buy when prices are meaningfully lower than normal. The investors who profited most from 2008 and 2020 weren't reacting emotionally in the moment. They had cash ready before the crash happened. Step 3. Check your portfolio once a quarter, not once a day. This sounds simple, but it might be the hardest step of all. During the April 2025 tariff crash, people who checked their portfolios daily watched their balances drop for days straight. Many of them panicked and sold. People who checked quarterly never even noticed. By the time they looked, the market had already recovered and moved past it. Every finance app on your phone is designed to keep you watching. Every red number is designed to trigger a reaction, and every reaction during a crash is almost always the wrong one. The specific action: delete your brokerage app's price alerts during volatile periods. Set a calendar reminder to review your portfolio once every 3 months. Between those check-ins, do nothing. The data says doing nothing during a crash is the single most profitable decision most investors will ever make. Now let me put all of this in perspective with real numbers. The S&P 500 has averaged roughly 10% annual returns since 1957. That includes every crash, every recession, every war, every pandemic, and every tariff fight along the way. If you invested $500 a month at that historical average and simply never stopped, through crashes, through panics, through all of it, in 30 years, you'd have roughly $1.1 million. The crashes didn't stop the growth. They were part of the growth. Let's recap the 3 moves. Set up automatic contributions and never pause them. Dollar cost averaging turns crashes into buying opportunities. Build a separate crash fund so you have cash ready to invest when the market drops. And check your portfolio quarterly, not daily. The less you look during a crash, the more money you keep. No predictions, no speculation, just 75 years of data proving the same thing over and over. The market crashes, the market recovers, and patient investors win. If you want to master money in America, subscribe. Every week we break down the financial system into simple strategies anyone can use. No finance degree required. Next week, we're covering how tariffs are quietly raising the cost of everything you buy in 2026, and the specific steps you can take right now to protect your wallet. The next satisfying crash is coming, and when it does, most people will panic. A few will get rich. Now you know which side you're on. I'll see you in the next one.